Michael Burry, the famous investor portrayed in The Big Short, who made billions betting against the housing market before the 2008 financial crisis, has once again made headlines by betting against the stock market. And according to recent filings, Burry has a short position against the S&P 500 and the Nasdaq 100 indexes totaling to $1.6 billion. But should we be following in the footsteps of Michael Burry and shorting the market as well? Let's take a look at his background, track record, and methods to see if we can really trade like Michael Burry. So historically, Michael Burry has been a bear, especially quite recently. From declaring Tesla stock as excessively priced to raising alarm on ARK Innovation's potential pitfalls, he's been vocally bearish about speculative tech stocks, citing potential growth bubbles. Naturally, this gets attention. After all, he is the big short guy. If someone's equipped to detect bubbles, it's Burry, right? But it's not all green on the other side. His decision to short Tesla in 2020 to 2021 didn't pan out as price kept going higher and higher and higher. Burry had to face some huge paper losses with his Tesla shorts. He wasn't completely off the mark. His concerns about overvalued tech entities were valid, and it did plummet in 2022, vindicating his predictions. So if Burry always ends up being right eventually, does that mean we should be following him? Before we aspire to trade like Burry, let's understand who he truly is. Born and brought up in San Jose, California, his academic journey led him to study medicine and became quite a successful doctor in his own right. But he was bored with his work. His real passion was with investing. In 2000, Burry founded his own hedge fund, Scion Capital. He became obsessed with the housing bubble that was inflated at the time. Through painstaking research and analysis, he realized the subprime mortgage market was extremely overvalued and vulnerable to collapse. He started shorting mortgage-backed securities even as the banks and experts claimed the housing market was strong. Burry's foresight paid off when the housing market collapsed in 2008, leading to the Great Recession. His predictions were once again vindicated, and he made billions. However, his victory came at a great personal cost. Burry faced opposition and ridicule as he tried to convince others of the impending crisis. In the book, The Big Short, it is described how Burry had essentially locked himself away for 2 years while he waited for his bets to pay off. Not speaking to his wife or family. He endured immense pressure and isolation to the point of nausea and vomiting as he withstood massive losses before finally being proven right. His resilience, backed by his rigorous analysis and unwavering confidence, proved pivotal. Burry's success was not just due to luck, but it was deeply rooted in understanding the subprime mortgage market, and his meticulous research and analysis helped him with that. He had the courage to go up against conventional wisdom and make a bold bet, even when others were doubting him. And ultimately, he was proven right. And not many people talk about this, but Burry also has Asperger's syndrome, which he believes played a role in his unique approach to research, as the condition often leads to hyper-focus. So can we follow in Michael Burry's footsteps and try to become the next big short investor? Well, it's tempting to try to replicate his success. It's important to consider the risks involved. Burry's success came at a great personal cost, and it required a level of analysis and confidence that most people cannot replicate. I kind of understand a little bit about that nauseating, vomiting feeling because there was a time when I was trading and I lost 50% of my portfolio, and at that moment, it didn't feel good. Your confidence is crushed. You feel like you made a mistake and you are thinking, how much longer must I endure this? Or was I wrong? Should I just cut my losses? And it's not something I want to go through again. If you're able to stomach the mental and social beatdown that comes from investing like Michael Burry, then sure, by all means, copy him. But for most people, including myself, the normal route of dollar cost averaging or buying at market lows is a much wiser strategy to maintain some sanity. But for investors who are looking to up their game, like me, and try to pursue higher returns, then timing the bottom is honestly a much better way. I do this using indicators like the McClellan Oscillator, the high-low index, the put-to-call ratio, and the VIX. This is definitely not as exciting as all-in shorting the market. In fact, most of the time there isn't much action as you'll be holding cash until the time is right. So are you guys going to be shorting the market? Because for me personally, I will not be shorting the market. I'll be buying up bonds, commodities as a way to hedge against a downturn. And if you'd like to know why I am buying into bonds and commodities, hit the subscribe button and I will create some new videos that further explains what I'm talking about.